Hi, I'm Christine Benz, and this session is called How to Retire. I have been steeped in retirement planning for, the past couple of decades. And I recently produced a book called How to Retire. The session that you're about to see is kind of a short form version of my book. And so my book has 20 lessons about how to do retirement. In this session, I'll cover 10 lessons altogether. And I would say this is kind of a CliffsNotes version of my book. For those of you old enough to remember CliffsNotes, they were the sort of quick and dirty way that you could get up to speed on a book that you were supposed to have read, but maybe didn't. So if you found yourself on Sunday night not having read Moby Dick, for example, you could turn to the CliffsNotes version and get quickly up to speed. That's the goal of today's set of lessons. Going to talk about a number of different takeaways that were included in my book. One of the key ones is the importance of being holistic when you think about your retirement plan. I won't spend a ton of time on this. It's very individual specific, but I do find that people tend to err on one side or another when it comes to retirement planning. And by that, I mean they either focus just on the numbers and they think retirement planning is kind of an exercise in spreadsheeting. And it's absolutely true. You need the numbers to line up in your favor to support your retirement. But you also need to be thinking about the non-financial aspects of retirement. Things like where you'll go for relationships when you're no longer working, what will give you structure and purpose. Also things like healthcare. You might not have had to think a lot about healthcare while you were working within the confines of an employer provided healthcare plan. But when you're retired, you need to sort this out on your own. And you'll also need to think about things like housing. So I would say you want to be thinking about both sides of the ledger, not just finances, not just the non-financial fun aspects of retirement, but both of those things, because they really do link up. The second key lesson is I do believe that taking a phased approach to retirement is a best practice. And of course, not everyone can phase gradually into retirement. We know that people often separate from work for reasons that are out of their control, whether they have health issues or their spouse does, or they're taking care of an elderly parent or something like that, or maybe their job just becomes physically untenable to do later in life. And we also know that ageism is a thing in our culture and that some people are forced out of the workplace earlier than they might want to. But Laura Carstensen, who is the head of the Stanford Center on Longevity, makes the point in my book that ideally, you would phase into retirement. You might continue working in some fashion if you're able to do so, because there are a lot of advantages to continuing to work a little bit longer. So there are certainly financial advantages. One of the key ones is that if you are able to reduce the number of years that you're drawing upon your portfolio, well, everything becomes simpler with that financial plan. If you have a shortened time horizon that you'll be spending. Another potential advantage is that you may be able to delay Social Security filing if you're continuing to earn a paycheck. That obviously is a lot easier to do if you don't need that Social Security income imminently. You may be able to continue to make contributions to your savings if you're continuing to work. You may have the potential for additional tax-deferred compounding if you're investing within the confines of, say, a company retirement plan or an IRA. And if you are over age 73, you have to take what are called required minimum distributions. But if you're continuing to contribute to a 401k plan, you're able to forestall those RMDs from that 401k plan as long as you're employed and continuing to contribute to that plan. And then finally, you may be able to sidestep what we call sequence risk, which means basically that that if you happen to encounter a poor market environment early on in your retirement, that is a risk for your plan, because if you're spending too much during those periods, that leaves less in place in the portfolio to rebound and recover when the market eventually does. So if you're able to continue working longer, if you're willing to continue working longer, you may be able to ride out that bad market environment without having to pull any withdrawals from your investment portfolio. So that's another potential benefit of delaying retirement if you possibly can, and phasing into retirement. There are also some non-financial benefits. Earlier on, I talked about a lot of the things that we get from our work. So we get structure, we get relationships. Some of us get a sense of purpose from our jobs. If you're continuing to work in some fashion, you may still benefit from those things. You may have some level of intellectual stimulation and physical activity that go along with your jobs. Those can also be positives later in life. I think sometimes when people hear about phasing into retirement, they think of it quite literally that, I'm currently working 40 hours a week now. I'll go down to 30 and then maybe on to 20 and on to 10 at some point. And that's perfectly fine. That's one way of envisioning a phasing into retirement. But there are other sort of ways to approach it, maybe simultaneously with scaling back your hours. So one would be potentially if you'd rather do more remote work versus in person. You may embark on that negotiation with your employer to discuss changes in that. You may be able to negotiate on the type of work that you do. So you may have aspects of your job that you really enjoy and want to continue doing. And then you may also have aspects of your job that you don't like as much that you would like to offload. And of course, this all hinges on being in good standing with your employer. But if you are, I think it's well worth having those discussions about how you could find a more agreeable work-life balance. So maybe you could keep the best and leave the rest of your work obligations. And then some people may be listening to this and say, absolutely nothing about my current job appeals to me, in which case I think it's worthwhile to investigate whether embarking on some completely different trajectory might make sense. So it might be appealing to have a job where you're kind of feeling pretty worry-free at the end of your shift. Maybe something like Trader Joe's or Whole Foods or something like that, where you hang up your apron at the end of the day and you really don't think much about the job thereafter. You may be willing to think about another position that leverages aspects of your career that you did enjoy, but that you're not able to continue doing in your old job. Maybe you're able to find some other position that leverages those skill sets. Volunteering, perhaps taking a non-paid position might make sense, especially if you feel like your finances are in good shape, but you just continue to want to engage with other people. Volunteering can make a lot of sense. Entrepreneurship later in life is also a growing phenomenon where people feel like, because they often are covered by Medicare, they're often feeling like they have a little bit more flexibility in terms of their finances, that they can take a little bit of risk and perhaps scratch an entrepreneurial itch. So that's potentially something else to consider, where maybe it's not a full-time entrepreneur position, but maybe you are doing some side gig that scratches an itch that you were unable to do during your career. But I would say that as you embark on retirement, as you get within 5 or even 10 years of retirement, it's worthwhile to start thinking creatively about what this next chapter might look like for you versus thinking of retirement as kind of a hard stop. I think in a lot of ways, that's an old model for thinking about retirement planning. I would also urge people to do what I call my Sunday night calendar test, where if you are still working and you're looking at your calendar for the week ahead, inevitably you'll have some things on that calendar where you'll say, okay, great day on Tuesday, not such a great day on Thursday, just got to slog through that. use that exercise to inform how you shape your work life going forward. If you can be preemptive about it, if you can start to shift into aspects of your job that you enjoy more and de-emphasize those that you enjoy a bit less, to me, that seems like such a worthwhile recipe for staying engaged in work a little bit longer because of those great financial and non-financial benefits that I talked about. So, another key lesson to bear in mind as you think about your retirement plan is to think about maximizing your non portfolio sources of income. So, most of us come into retirement with our portfolios, whatever we've managed to save. And then we also typically can avail ourselves of non-portfolio sources of income. So for most of us, that'll be Social Security. That's kind of front and center in terms of our non-portfolio income. Some people, although it's a dwindling share of our population, might have some type of income from pensions. People might have income from work. If you're phasing into retirement and continuing to work in some fashion, you may have working income. Some people may own rental properties from which they derive income. And then there are other kind of idiosyncratic sources of income that people might have. So you might have ownership in farmland, for example. And of course, those are very individual specific. But the key benefits of non-portfolio income sources is that some of them are lifetime benefits. So that's particularly true for Social Security. Some pensions will last throughout one's lifetime. Some annuities also provide a lifetime stream of cash flow. Your portfolio, by contrast, is not guaranteed to last you a lifetime. So that is one of the key reasons why those non-portfolio income sources can be so valuable. Some of those non-portfolio income sources may have some level of embedded inflation protection. So think of Social Security. It's a lifetime benefit, and it also has inflation adjustments that are in line with whatever the consumer price index is. So think of 2022, for example, which was the year that we saw inflation shoot up in the US. Well, people who were receiving Social Security received very nice inflation adjustments to help keep their purchasing power, to help their purchasing power maintain its wherewithal in the face of inflation. So that inflation protection is super valuable. Some of that inflation protection may be explicit. So Social Security is a good example of that, or some of it may be implicit. So rental income is a good example of this, where someone might have a rental property, and in a period of higher inflation, as a landlord, you're often able to push through rent increases in those periods. Certainly over time, you are able to boost the rents that you are charging for those properties. So that is a nice feature of non-portfolio income sources that won't necessarily be there with your portfolio, that built-in inflation protection. To the extent that you can enlarge your non-portfolio income sources, it makes everything about the retirement plan easier. It alleviates the need to spend as aggressively from the investment portfolio. You can take a lower withdrawal rate from that portfolio if you've enlarged those lifetime income sources. And interestingly, if you have enlarged your lifetime income sources, so for example, you've taken steps to enlarge Social Security, perhaps by delaying your benefits, one of the key benefits is that you can be somewhat flexible with the amounts that you take from your portfolio. So I'll spend a little bit of time talking about portfolio withdrawal rates in a minute. But one of the best practices when we look at how much you can safely withdraw from your portfolio is that if you can be flexible with those portfolio withdrawals, that really redounds to the benefit of your plan. And it stands to reason that if you're able to enlarge those non-portfolio income sources, it allows you to be a little bit more flexible. So that's another key benefit to enlarging lifetime income. So, a couple of caveats to bear in mind when thinking about non portfolio income sources. Well, one is that you often hear that you should delay Social Security or you should buy an annuity to enlarge lifetime income. And certainly there's something to be said for those strategies. But the main winners in those scenarios would be people who live a long time. If for whatever reason you think that you will have a shorter than average life expectancy, so for example, perhaps you've encountered some dire diagnosis, you're oftentimes better taking Social Security earlier rather than delaying. And that's especially true if you're single. It may be less true if you have a spouse who will be reliant on your Social Security income. But definitely, if you have a shorter than anticipated life expectancy, the value of enlarging your non-portfolio income sources, either by delaying Social Security or purchasing some sort of an annuity that will last you a lifetime, the benefits of those strategies will be less if you do not live a long time. Another key knock on annuities, and actually there are several that I want to run through. One is that, and I should just pause and say, an annuity is, in its very basic form, it's a contract that you sign with an insurance company where you hand over a sum of money to the insurer, and in exchange, the insurer offers to pay you a stream of income throughout your lifetime or through some predetermined, pre-agreed upon time period. And so that's a very basic annuity type. But one of the main disadvantages to an annuity is that you can't buy an annuity that includes an inflation adjustment that is in line with whatever the consumer price index is. I mentioned Social Security offers that very nice feature, but you can't currently buy any sort of an annuity product that will offer that CPI linked inflation adjustment. So that's a major disadvantage, because if you're getting X number of dollars a month or year from an annuity and it's not adjusting in line with inflation, well, your purchasing power is going to shrink, right? As the years go by. And if retirement is maybe 20 or 30 years long, that sum that seemed perfectly decent at the outset of your retirement will seem like less and less and less as the years go by. So that's a key disadvantage of the annuity, even though the idea of having that stream of lifetime income is very attractive. That's a disadvantage. Another one is that the insurance company backing it may not necessarily remain solvent. Oftentimes it is wise, or it is wise, to do your homework about the financial strength of the insurance company, because this is a relationship that you'll have if you purchase an annuity that could last 20 or 30 years or more. So you want to make sure that that insurance company is going to be able to make good on its promised payments to you. So you've given them a sum of your money. You just want to make sure that they'll be able to hold up their end of the bargain. Then another key knock on annuities is that many of them are very complicated. They can be very costly, and that can erode the advantages that we talked about, that advantage of having that lifetime income stream. And then finally, when you think about other non-portfolio sources of income, rental income, for example, might be subject to disruptions. So, for example, if your tenant moves out and it takes you a couple of months to replace him or her, well, that obviously will lead to a disruption in your income. The same goes for work income. That I often talk to people who say, yeah, my retirement plan is to continue working. And I often feel a little bit worried about that, because people may not be able to continue working as long as they anticipate they might be able to. So this is just a chart that shows the value of delaying Social Security if you can. You can see if you delay from age 67 to age 70, you can pick up a roughly 24% increase in your benefits. So you pick up a roughly 8% increase that you're able to delay every year past your full retirement age, which is currently 67 in the US. So that's a nice way to enlarge your eventual benefit. And that can also be valuable if your spouse will take your benefit, will assume your benefit if you should predecease him or her. That's a nice way to enlarge that benefit that your spouse will in turn receive in that instance. So it's definitely a strategy to think about, especially if you have average or above average life expectancy. The good news is that we had been seeing for many years retirees oftentimes claiming early, so claiming at age 62 and taking a permanent haircut to their benefits. What we're seeing is that I think the message is starting to get out there about the value of delaying Social Security if you can, that we're starting to see the numbers of people who are delaying Social Security elevate quite nicely. And I think they're seeing the math here that if you do have an average or perhaps above average life expectancy, you do see a benefit in terms of an increased lifetime benefit from Social Security through delaying. Hi, and welcome to the second installment of How to Retire. I'm Christine Benz. I'm Director of Personal Finance and Retirement Planning at Morningstar. I'm also author of the book called How to Retire. So I had just talked about the value of enlarging non-portfolio income sources. Another key thing to think about as you work on your retirement plan is figuring out what retirement income style makes sense to you and appeals to you. So this is a framework that was developed by retirement researcher Wade Pfau. And Wade identified 4 key quadrants that we might fall into with respect to our retirement income preferences. So the top right-hand quadrant is kind of a total return approach to managing an investment portfolio. So that would be someone who wants to keep tabs on their money, have access to their money. So they would be looking for an optionality orientation, meaning that they want to be able to get in there and make changes to the investments as they determine is appropriate. So they're looking for optionality with respect to their investment portfolio. And they're also looking to not necessarily have guarantees. They want to rely on market gains, but they know that those gains are not guaranteed. So that would be someone who's going to use a total return approach to managing the portfolio. They're periodically going to spend from that portfolio. They can have any number of investment assets in the portfolio. On the opposite side of this grid here is someone who has a safety first and commitment orientation. So that's kind of the opposite of the orientation that we just talked about, where someone is very focused on safety and is less focused on growing the portfolio over time. And they basically want to lock down a retirement income solution. So they want to embark on retirement and say, okay, here's where I'm going to go for my paycheck on an ongoing basis. I know that that doesn't necessarily give me the highest rate of return, but I want to lock down a solution and not have to worry about this again. So that would be sort of the other extreme in terms of retirement income styles. And then there are 2 hybrid styles that Wade has developed. One is the top left square, where someone wants to maintain ongoing access to their portfolio, but they want to maintain it it in kind of a time segmented approach. So they want to have very safe assets that they could pull from. They want to have more growth oriented assets, and then potentially some sort of bond assets, which would fall between those two extremes. So that's one hybrid strategy. And then another hybrid strategy, the bottom right-hand quadrant, would be someone who is looking for some market growth, as one would get with some sort of stock component to the investments, but they also want some risk sort of oversight on the portfolio. So that would be kind of a variable annuity type product where there are some guarantees built in, but there's also the opportunity for some stock market growth. So Wade's view is that each of us has a retirement income style. One thing that might appeal to me might not appeal to you. So it's really valuable to take a step back and think about what you're looking for in terms of your retirement income, in terms of your cash flows in retirement. And there are really two primary questions, as I mentioned. One is, are you safety first or are you probability oriented? And then the second question is, are you commitment oriented? Do you want to lock down a strategy and never have to revisit it? Or do you seek optionality? Do you want to be able to go in and make adjustments to your portfolio? Do you want regular access to your funds? So answering those two questions and thinking about your responses can help you home in on the right retirement income solution. And if you're part of a couple, you may have differing views on these topics. And one of the more hybrid type strategies might appeal to you. If one of you is extremely safety oriented and the other one wants to have a portfolio that experiences more market growth, then perhaps either that bucket/time segmentation type strategy or some sort of what Wade calls a risk wrap type strategy might make sense for you. So if you want safety first and commitment, as I mentioned, the best example of that orientation would be someone would gravitate to a very basic income annuity where you are sending the insurance company a portion of your portfolio, and then they're just going to send it back to you as a stream of income throughout your life. That would be sort of the extreme epitome of a safety first and commitment orientation. On the other hand, as I mentioned, if someone likes a more probability based approach and likes that optionality or likes the idea of having access to his or her funds, then a total return portfolio with periodic withdrawals from that portfolio would make sense. And then the last two strategies are, as I mentioned, hybrid strategies. If you want some safety but don't necessarily want to be locked into an annuity product, then using a bucket type portfolio, which I'll discuss in a minute, is a way to have really both sorts of things where you're setting up safe assets, but you're also giving the portfolio the opportunity for long-term growth. And then another hybrid sort of strategy would be if you are probability based, so you want market growth, but you also want to lock down a more or less permanent solution throughout your retirement, then what Wade calls risk wrap could come into play, where you're looking at perhaps some type of a variable annuity to provide you with lifetime portfolio cash flows. That strategy might be appealing. So once you've homed in on your retirement income style and in turn your strategy, it's wise to then think about how to create a sensible spending plan from your investment portfolio. So say you have some portfolio set aside that you intend to spend from in retirement, you need to figure out how you can safely spend from the portfolio. This is arguably the hardest problem in all of financial planning because you're planning planning around so many uncertainties. So for one thing, you don't know how long your time horizon will be. You don't know how long you'll live. That's a huge wild card. You don't know how the stock and bond markets will perform over your particular drawdown period. And you don't know what inflation will be. So on this slide, you can see various withdrawal rates that would have been supported at the outset of various 30-year periods over market history. So each of the dots on this graph corresponds with what would have been a safe starting withdrawal percentage at that point in time for the 3 decades ahead, for the 30 years ahead. And you can see that this is all over the map because it depends on how the market performed and what inflation looked like over the subsequent 30-year period. So you can see that there are periods where an all equity portfolio, an all stock portfolio, 100% stock portfolio would have supported a very high withdrawal rate. So for example, in the post-World War II period, for example, that was a great time to have retired with a lot of stocks in your portfolio because the U.S. economy went on to have a record expansion and the stock market came along for the ride. So if you had the good fortune to retire with that all stock portfolio during that period, you could have taken a very high withdrawal and still not run out of money over the 30-year horizon. On the other hand, there have been other times in market history. So I would kind of focus your attention in that late 1960s period when it didn't matter what was in your portfolio, whether you had all stocks, all cash and no stocks, or a blended portfolio and stocks and bonds. It didn't matter. None of it contributed to a very high starting safe withdrawal percentage. So you can see that this is all over the map, and it's very difficult to guess in advance what specific withdrawal rate would be supported. So market history can give us a little bit of a clue about what to expect, but it's not necessarily the only way to think about determining a safe spending rate. So we often hear about the 4% guideline for retirement portfolio withdrawals. This is based on a backward-looking view of market history. It's been stress tested over a lot of different market conditions. So the original research on safe withdrawal rates was done by a financial planner named William Bengen back in 1994. That's where the 4% guideline was born. He homed in on that period in the late 1960s and 1970s. And his conclusion was that if you took 4% of a portfolio in that period as a starting withdrawal, and then inflation adjusted whatever that dollar amount was thereafter. So for example, if I have $1 million portfolio and I take 4% in my first year, that's my $40,000 year one paycheck. Then I give myself a little raise to keep pace with inflation as the years go by. That was the basic formula in play with the 4% guideline. So it's certainly a good way to anchor thinking about safe spending rates if you are, say, 5 years from retirement and you're trying to figure out if you've saved enough. It's a good starting point, this 4% guideline, but it is based on market history. We don't know necessarily what specific conditions might hold over your specific retirement drawdown period. And then another thing that we don't know is how you will spend. And so when we look at the data, what we see is that retirees tend to spend a bit less than the inflation rate as the years go by. So if inflation is, say, 3%, retirees may increase their spending by just 2%. And this is some research that was done by one of my former colleagues at Morningstar, David Blanchett, where he examined retirement spending over actual retiree households over the retirement life cycle. And what he found was is that people do tend to spend less as their retirements unfold. And then in some households, spending flares up later in life. So you can see in sort of that post 85 period, spending is going up. And that's largely because some households do have high out-of-pocket costs late in life, largely because of uninsured long-term care costs. So this is an important finding because if we don't assume that the retiree is necessarily taking inflation adjustments that are in line with actual inflation, what we can do is that we can elevate that first year spending. So in a lot of ways, a 4% style spending guideline is built for a worst case scenario, and it also assumes that retiree will take the inflation adjustments in line with CPI when in fact the data don't necessarily bear that out. So that's a particularly important finding for people, especially those who have tighter financial plans, where if you have a choice between spending a bit more in the early years of retirement and really trying to maximize your enjoyment in those early years, in exchange for potentially taking less as your retirement unfolds, many retirees might say, okay, I'm good with that bargain. So I think that is something to keep in mind as you think about your retirement spending plan, that even though the 4% guideline is a good starting point, it may lead to underspending because it doesn't necessarily factor in how retirees actually spend. Nor does it necessarily incorporate the fact that conditions may be better than kind of the worst case scenario that the 4% guideline is designed around. So that's another caveat here as well, that if you are willing to revisit your spending on an ongoing basis, if you're willing to adjust if the market is particularly good or bad, take less when the market's bad and potentially take more if the market's good, well, that can help enlarge your lifetime spending. So as I mentioned earlier, being flexible with respect to your portfolio withdrawals has emerged as kind of a best practice, in my opinion, in the realm of safe retirement spending rates. This is a slide that is pulled from some research that I work on with a couple of my colleagues at Morningstar, where we examine all kinds of different systems for retirement spending. And if you're interested in doing a deep dive on this topic, you can Google state of retirement income. The most recent research was for 2024, but this is research that we anticipate updating each calendar year. And we examine different spending strategies. So the base case in the far left is a 4% style spending guideline where you're taking X percentage of the portfolio in year one and then inflation adjusting that dollar amount thereafter. So what you can see on this slide is as of our most recent data run, we determined that a 3.7% starting withdrawal was the highest safe withdrawal rate for someone with a balanced portfolio, assuming that they never wish to revisit that starting spending rate. They'll just take that 3.7% initial withdrawal and then inflation adjusted thereafter. So you can see that this tends to, because it's built around kind of a worst case scenario, it tends to lead to significant balances at the end of that 30-year period, that many market environments are better than the worst case scenario. So there are significant leftover balances. The other strategies that we looked at, whether the required minimum distribution style spending strategy or a strategy called guardrails, all tend to diminish that year 30 balance because they lead to ongoing adjustments in spending as the years go by. So there's a lot to digest here, but a couple of key takeaways is one, be flexible if you possibly can by lining up more of your income needs needs through non-portfolio income sources like Social Security, I think you're more able to adjust your withdrawals up or down based on how market conditions are. So that's a key takeaway. And another key thing to think about is how you feel about maximizing your own lifetime spending versus leaving a leftover balance at the end of your life. If you're someone who very much prioritizes leaving a bequest, whether for children or grandchildren or charity, then in that case, you may be better off using kind of something a little closer to a static spending system where you're not making regular adjustments. But if you are more consumption oriented, if your goal is to really enjoy the fruits of your labors, in that case, you should explore some of the more flexible strategies, whether the ones that we explore in our research paper or some other ones. A really simple one that I would just call out on this slide is simply not taking an inflation adjustment in the year after a portfolio has had a loss. So a great recent example was 2022. Most investment portfolios were down because the stock market was down and the bond market was down. If in a year like that, you don't give yourself an inflation adjustment in the following year, so in 2023, you wouldn't have given yourself any sort of inflationary raise. Well, that sort of strategy nicely helps enlarge lifetime spending relative to just that base case on the far left of the screen. And it also leads to a higher starting safe withdrawal percentage. So there are some simple strategies like that you can explore to help enlarge lifetime spending and to help enlarge your starting withdrawal percentage. So another key thing to think about with respect to retirement spending is that being flexible with your spending actually works behaviorally. And this was an insight that came out in my book. Jonathan Guyton, who developed what's called the guardrails approach to retirement portfolio spending, made the point that a lot of things that we want to do because they feel like the right thing to do. So, potentially pulling out of stocks when the market is down. That's something that might feel good, but isn't great for the long run results of our portfolios, but actually taking less from our portfolios when they're down and potentially taking more when they're up. Well, those are things that actually align with what's good for our portfolios. That if we take less when our portfolios are down, that leaves more in place to recover when the market eventually does. And the same goes for taking more when the portfolio is up. If we're feeling flush in those years, well, guess what? It's probably an okay time to take some profits from that portfolio. So I thought that was kind of a neat insight that those two things line up for a change, that what feels right behaviorally is also the right thing to do from an investment standpoint. Another key thing to think about with respect to your retirement plan is structuring your portfolio to support your cash flows. So if you've maximized your non-portfolio income sources and you've homed in on your retirement income style, and you've thought about how you will spend from that portfolio as retirement unfolds, then the next step is to structure that portfolio to help supply those ongoing cash flow needs. I've been a big proponent of what's called the bucket approach to retirement portfolio planning. And this simply means that you organize your portfolio in line with your expected spending from that portfolio. So to use a simple bucket strategy, I might take a couple of years worth of my anticipated portfolio cash flows and put them in something very safe. So I might hold them in CDs or in some sort of a money market account or something something like that. I'm not taking any risk with that portion of the portfolio. I'm courting some inflation risk, but I'm not taking any investment risk. I'm basically locking down my cash flows for the first couple of years of retirement. And then I'm stepping out on the risk spectrum from there. So with bucket 2, I might hold another 5 to 8 years worth of portfolio withdrawals in something like bonds, high quality, short and intermediate term bond portfolio. Here I could use bond funds for simplicity or exchange traded funds for simplicity. So rather than having to hold individual bonds, I would just hold a good quality short and intermediate term bond fund. And I'm earmarking another 5 to 8 years worth of portfolio spending. And then anything else. So cash flow needs for the later years of my retirement. Well, those I can hold in stocks because I know that over time horizons of 10 years or longer, stocks are actually extraordinarily reliable. So with buckets 1 and 2, I've got effectively 10 years worth of portfolio cash flows. And if Armageddon shows up early on in my retirement, if I have a bad stock market, maybe even a little bobble in the bond market, well, I know I could pull from those safer assets first, then move on to high quality short-term bonds, then maybe move on to high quality intermediate term bonds. I know that I have enough safe assets set aside to tide me through prolonged bear market for stocks. And so that's the basic intuition in place with this bucket strategy. I think it's a strategy that really makes sense from an investment standpoint, and it works behaviorally because people know that they have assets that they could spend from, and they don't have to really upend their plans in case of a bad bear market showing up early on in retirement. So a couple of sample in retirement bucket portfolios I'll walk you through. In these simulations, I've assumed $1.5 million portfolio. Even if your portfolio is substantially smaller than that, the dollar amount doesn't really matter. What matters are the percentages. And so you can retrofit these portfolios to fit whatever portfolio size you're bringing into retirement. But I'm assuming a 65-year-old couple with a $1.5 million portfolio. I'm assuming they have a roughly 25 or 30 year time horizon in retirement, and that they're taking a 4% initial withdrawal with 3% inflation adjustments thereafter. So that 4% on a $1.5 million portfolio translates into a $60,000 withdrawal in year 1 of retirement. And then they might also have cash flows coming from somewhere else. So we talked about Social Security, for example. Maybe they have another $30,000 or $40,000 coming from Social Security, but I'm not really worrying about that for the standpoint of this exercise. I'm really focusing on how much the portfolio withdrawals will be. So in this case, I've got 2 years worth of portfolio withdrawals in that first bucket, that cash bucket, another 5 to 8 years going into that bond bucket. And then I've got the remainder going into the third bucket. And if we look at a sample portfolio based on exchange traded funds, it would look something like this. So I've got 2 years, so $60,000 times 2 in cash, and then another $480,000, so 8 years times that $60,000 cash flow in a bond portfolio. So I've got a short-term bond fund here. I've got a very inexpensive index fund. I've got a little bit of an intermediate term bond fund. So I've got iShares Core US bond market. You could also use Vanguard Total Bond Market or Vanguard Intermediate Term Bond Index, something like that. I've got a little bit of what are called inflation protected securities. These are bonds whose principal values in change in line with whatever inflation is. So they're designed to help protect your purchasing power. And then I have a little bit of dividend paying stock portfolio in this portion of the portfolio as well. But the main entree in this bucket 2 is that high quality fixed income piece. And then bucket 3 is a globally diversified equity portfolio. To the extent that you have any other high risk components in your portfolio, I would hold them with a nice long time horizon in mind. So I'd keep them in this bucket 3. So whether it's gold or commodities or some sort of crypto, I wouldn't necessarily recommend that people carry those assets into retirement. But to the extent that you have those higher risk other assets in your portfolio, I would hold them in this bucket number 3, where you're giving yourself that nice long time horizon. So I've got a dash of high yield bonds in this component of the portfolio. You can do the same thing with mutual funds. The preceding portfolio was all exchange traded funds. These mutual fund portfolios very much mirror the contours of the exchange traded fund portfolios that I just talked about. You can also do very minimalist versions of these portfolios. So here you've just got that liquidity bucket, the cash bucket. You have an all-in-one fixed income portfolio, same size, same general time horizon in mind. And then you have a globally diversified index fund portfolio at the tail end of that portfolio. You should also factor in where you're holding these assets. So the preceding portfolios that I just talked about are all earmarked for tax sheltered accounts. So they're assuming that you would be holding the investments in an IRA or in a company retirement plan or something like that. But if you have assets outside of the confines of tax sheltered accounts, so maybe you have a taxable brokerage account, well, you'd very much want to factor in tax management when building out that portfolio. So if you have that cash bucket, you might hold it in a municipal money market fund where you're not going to pay federal taxes on those income tax payments. You might hold the bucket 2 in short and intermediate term municipal bond funds, where again, you are sidestepping the federal tax on the income distributions that come from those holdings. And finally, for that bucket number 3, index funds or exchange traded funds especially tend to be really nice tax efficient mousetraps for those equity holdings. So that's a way to take this bucket approach and make it applicable to a taxable portfolio where you're not getting those tax sheltering features of the tax deferred or Roth accounts. Hi, and welcome to the third installment of a discussion about how to retire. I'm Christine Benz. I'm Director of Personal Finance and Retirement Planning for Morningstar. I also worked on a book called How to Retire. So this session and the ones that preceded it is a distilled version of some of the lessons included in my book. So we talked about how to structure a portfolio for cash flows. Another key thing to think about is to bear in mind the tax considerations. So I just touched on them in the preceding session where I talked about if you have taxable non-retirement account assets, you want to take care in how you manage them and what you hold inside those accounts. But before we go any further, when we're thinking about tax consciousness and bearing in mind reducing the drag of taxes on our investment gains, it's worthwhile to run through the tax treatment of the 3 main types of accounts that people would be bringing into retirement. So they tend to fall into 3 key categories. The first one would be what are called traditional tax deferred accounts. So these are accounts where you may enjoy some type of a tax break on your contribution. So a company retirement plan like a 401k, for example, is a great example where you're able to earn a tax break on the money that you put into your traditional tax deferred account. So that doesn't count it as income in the year in which you make that contribution. You don't pay any taxes on any investment gains that occur inside those accounts as long as the money stays inside those accounts. The issue is that because there are those nice tax breaks going in, and while your money is inside the account, the withdrawals are typically fully taxable as income to you. There are also required minimum distributions that apply to tax deferred accounts, whether IRAs or company retirement plan assets, where at age 73 currently, you will need to begin taking out funds from the account on a predetermined schedule. So that is another thing to bear in mind with traditional tax deferred accounts. And finally, there are some new rules for IRAs that are inherited by other people. That's really beyond the scope of what I'll cover here, but that's something to bear in mind, that if your goal is to leave the assets for heirs, the tax advantages of doing so with traditional tax deferred accounts are a bit less than they once were even just a few years ago. So Roth accounts have basically the opposite tax treatment of traditional tax deferred accounts. So you do not earn any sort of tax break on the funds going in. In fact, if you put assets in into a Roth account, those assets will be taxed before they go in. Like tax deferred accounts, you're not going to pay any taxes on Roth accounts as long as your money stays inside of the Roth account. There are no taxes in retirement, though. So no tax breaks going in, but you are able to enjoy tax-free withdrawals in retirement. So if you have a Roth IRA, for example, once you're 59 and a half or older, then you're able to take tax-free withdrawals from that account, assuming that you've met a few other kind of arcane rules related to Roth IRAs. There aren't any required minimum distributions on Roth accounts either. So for people who want to continue to maintain their balance inside of a Roth account, there's no one kind of tapping you on the shoulder at age 73 telling you it's time to start withdrawing your money. You can leave the funds in the account. They're also really nice accounts for your heirs to inherit because your heirs will not pay taxes on them. So those are a couple of the things to know about Roth accounts. Finally, taxable brokerage accounts do not offer tax breaks on contributions. They don't offer tax breaks on the money coming out, as is the case with Roth accounts. You will owe taxes on any income and capital gains that occur inside the accounts, even as long as you hold the funds in those accounts. If your investment accounts make gains or if they distribute income to you, you will owe taxes on those distributions. The nice thing about taxable brokerage accounts, well, there are a few nice things. One is that there are no income limits governing who can contribute to them or how much you can contribute to them. There are no rules about withdrawals there aren't any rules about what you need to be invested in. And then if you have investments that produce what are called capital gains, so if they appreciate in value over your holding period, you are often able to enjoy what's called capital gains treatment. When you eventually sell those assets, you won't owe income tax, you'll owe capital gains tax, which is lower than the income tax rate. And then finally, a key benefit of, a couple of key benefits of taxable accounts is that there aren't any rules regarding mandatory distributions at age 73 or at any age. And then there are also really nice assets for your heirs to inherit. So for example, say you own some stock that has appreciated really nicely over your holding period. if your heir inherits it from you, what's called the cost basis in that asset is whatever it was on the date of your death. So to use a simple example, say you bought Apple stock for $10 a share and it's trading at whatever it is today, some elevated value, your heir's cost basis is that much higher value. And so when he or she sells that asset, eventually the taxes are that much less because they're based on that very high new cost basis. So that's one reason why those are attractive assets for your heirs to inherit from you. But it's important to pay attention to tax considerations. So in addition to kind of understanding the basic rules governing these various accounts, when you're in retirement, it's very valuable to think through, well, how can I try to minimize my tax burden from my investment accounts? So in the pre-retirement years, it's valuable to think about which types of accounts to fund. And it's also valuable thinking about which assets to hold within various investment accounts. So previously I talked about the value of being thoughtful if you have those taxable brokerage accounts, being thoughtful about what investment types you put inside those accounts. By the same token, if you have tax sheltered accounts, you'd want to think about taking maximum advantage of what they offer to you, which is the ability to shelter your gains on a year-to-year basis. So if I have something that's kicking off a lot of income from year to year, whether it's maybe some sort of a real estate investment, or maybe it's some sort of a bond that has a lot of income attached to it that I would owe taxes on if I didn't hold it in a tax sheltered account. Those are great investment types to hold within the confines of a tax sheltered account. When you're in retirement and assuming that you have multiple silos that you're holding assets in, it's also worthwhile to think about sequencing your withdrawals. Where are you going for your cash flows on a year-to-year basis? Kind of the standard rule of thumb when we think about retirement planning is that we're pulling from non-retirement accounts first. So if we have taxable brokerage accounts, we may be using them as our starting sources of cash flows. And then perhaps we're moving on to traditional tax deferred accounts, and we're saving the Roth accounts for last, generally speaking, because their tax advantages are the greatest, right? If I'm able to not owe any taxes on my eventual withdrawals, those are the most valuable assets for me to own during my lifetime. And I also mentioned that they're good assets for your heirs to inherit. So it's worthwhile to think about your sequence of withdrawals. And by the way, I'll just pause and say, if none of this interests you, or if you have no interest in really understanding these topics, that's totally fine. But I would get some advice about how to approach my withdrawals with an eye toward trying to reduce my tax burden throughout my time horizon. You'd also want to think about which assets to earmark for heirs and or charity. So there are some assets that are more advantageous for heirs to inherit. I mentioned that step up in the cost basis that your heirs receive when you die and they inherit taxable assets from you. By the same token, Roth accounts are also very nice assets for your heirs to inherit from you. On the other hand, to the extent that you have traditional tax deferred accounts, those are great assets to earmark for charity because the charity will not owe any taxes on funds that they inherit from you that are held within those accounts. So those are really nice assets to earmark for charity to the extent that you're charitably inclined. You'd also be wanting to think about whether to potentially convert any traditional tax deferred assets assets to Roth. So you have the opportunity to convert and pay income tax to do so, to convert traditional tax deferred assets to Roth. That's a great spot to get some tax advice, to think about whether conversions are warranted. The beauty of doing those conversions is that you would have tax-free withdrawals from those accounts once they're converted to Roth, and you wouldn't be subject to required minimum distributions, but you would need to pay taxes on those converted amounts. So it's a great place to get some tax help, just to make sure that you're thinking through the implications for the rest of your tax bill for the years in which you might convert those traditional tax deferred accounts. And then finally, the tax effects are a little bit of a Rubik's Cube, where you can do one thing and cause tax effects with other parts of your plan. And so it's worth thinking through all of the implications. Another reason why it might be valuable to get some tax guidance as you move into retirement decumulation. While you're working, your tax bill often is what it is. You don't have a lot of opportunity, apart from, say, funding your tax sheltered retirement accounts, to reduce your tax bill. But in retirement, you have a lot more levers available to you. So it is a great spot to get some help. Wanted to shout out for the post-retirement pre-required minimum distribution period as a particularly opportune time to mull some strategies to potentially reduce future tax bills. So that's a great life stage, because your income is often at its lowest ebb relative to other periods in your retirement. That's a great spot to potentially consider converting some of those traditional IRA balances, IRA or 401k balances, to Roth. And the basic idea there is that if you're no longer working and you're not subject to those RMDs yet, well, you can keep your taxes low. And so you may be able to do those conversions at a fairly low tax rate and with a fairly low tax bill attached to them. Those are also good years to consider potentially accelerating withdrawals from your traditional tax deferred accounts to potentially shrink the amount of your balance that will be subject to those required minimum distributions. And then those can also be great years to make charitable contributions. In particular, once you're older than age 70 and a half, and before those required minimum distributions commence at age 73, that can be a great time to use what are called qualified charitable distributions, where you're sending a portion of your IRA to the charity or charities of your choice. And the virtue of doing that is that that is basically a tax-free maneuver, that you are able to get money out of your IRA or out of your IRA without any taxes associated with it, because you're contributing those amounts to charity. So that's another strategy to consider. And by the way, it also helps reduce the amount of your balance that's eventually going to be subject to those required minimum distributions. The next lesson, and we could do this whole session on this topic because it's such a big and important one, is to formulate a long-term care plan. And so certainly you want to think about what long-term care is. And I'll just state that it is not healthcare technically. So it's not covered by our traditional healthcare systems. It's not covered by Medicare. It's not typically going to be covered by your traditional insurance unless you've purchased what's called a long-term care insurance policy. But this is care that you might need later in life to help you with what are called activities of daily living. So those might be things like showering and bathing, making meals, feeding yourself, getting out of a chair, whatever the case might be, all of the things that you need to live your life. And those are activities that people might run into problems with later in life, often because of cognitive decline or other physical challenges that might keep you from being able to do those jobs unassisted, where you might need some help. So that's basically what long-term care is. So you want to be thinking about, well, first of all, how you will pay for it. And there are really three main ways to pay for long-term care. One is to rely on government provided care. As I mentioned, it's not covered by Medicare, but it is covered by Medicaid, assuming that you've largely exhausted your other resources. And there are a lot of people reliant on Medicaid provided long-term care in the US. In fact, Medicaid is the largest payer of long-term care. So that's one category for people without a lot of financial assets. They will probably be reliant on Medicaid to provide their long-term care. Another category at the other extreme would be for people with a lot of assets. They would potentially self-fund long-term care, where they are using their own assets to cover long-term care expenses if they should arise. And then in the middle would be people who would purchase some type of an insurance policy to specifically address long-term care needs if they should arise. So you'd want to think about which category you fall into. Your financial circumstances will no doubt dictate where you fall on this spectrum. And then you'd also want to think about how you would wish to receive care if you needed it. So many people do have a strong preference to receive care at home. You may also want to explore receiving help from family members, or perhaps you have a really strong preference to receive care not from family members, from paid caregivers. So it's worthwhile to articulate your vision for how you would receive long-term care if, in fact, you needed it at some point in your life. I covered what Medicare doesn't cover. It generally doesn't cover long-term care expenses. Medicaid does, but the eligibility is subject to strict income and asset limits. It's also worth noting that the Medicaid programs typically have what's called a look-back provision. And that basically means that it precludes you from being able to gift assets to your loved ones if you feel that you may have a long-term care need imminently and think, okay, I'm going to sort of prematurely deplete my assets and give it to my children to have them hold the money for me. The problem is that Medicaid programs typically look back and they count such assets back in as part of your own assets. So that strategy is effectively off limits for people who might think to do some gifting along those lines. And then finally, a key thing to know about Medicaid provided care is that there are limits on where you can receive care. Some states are experimenting with home-based care because, as I said, many people would prefer to receive care in their homes versus some type of institutional setting, but you may not be able to have your choice about where you would receive care if you were reliant on Medicaid provided care. Insurance is another option. I mentioned that that's a fit for kind of that middle bucket where you aren't totally sure that you'll have assets to cover long-term care expenses if you should need them, but you don't necessarily want to be reliant on government provided care. And so there are two main categories to address long-term care insurance. One is a traditional long-term care insurance policy. There are a couple of caveats to bear in mind. One is that it has been a troubled marketplace where we've had a shrinking share of insurers offering these types of policies. In turn, we've seen significant premium hikes. So people who thought that they were lining up some sort of a solution for long-term care have been confronted with the choice between either paying a higher premium or reducing their future benefits. And then another key thing to keep in mind with the traditional long-term care policies is that their underwriting strategies, underwriting standards might be fairly strict. So you might have some healthcare condition that would preclude your ability to purchase long-term care insurance. Increasingly, we've seen what are called called hybrid life/long-term care policies become more popular. So this is typically a life insurance policy with a long-term care rider attached to it. And there's an attractive optionality to these policies in that one of these two things will happen to you, right? That either you will have a long-term care need or you will die or you will die. And so it's offering you protection against either outcome, basically. So these have become more popular. The underwriting standards, as far as I understand them, are less strict than is the case for the pure long-term care policies. And they might be appropriate for people who already have some sort of a permanent long-term care, or permanent life insurance policy, I should say, who are now more concerned about having a long-term care need. You can do a conversion from that pure life insurance policy into one of these hybrid policies. The drawbacks with these hybrid policies is that they can be a little bit opaque and difficult to sort among them, difficult to figure out how to compare one policy relative to another. I would always say get some objective guidance in this area, whether you're purchasing a pure long-term care insurance policy or you're exploring one of these hybrid policies. Get some objective guidance where the person who is helping you sort among these products is not going to earn any sort of commission based on whatever decision you end up making. Just quickly to touch on self-funding, if that's the route that you wish to go in with respect to long-term care. If you have decided to segregate a portion of your portfolio for long-term care, the data about long-term care usage, I think, can be super useful in terms of determining how big that long-term care fund should be. So when we look at the data on long-term care usage, we see that the typical length of long-term care need is 1.5 to 2 years. It tends to be a little bit longer for women, and women also tend to have a higher long-term care usage overall. And that's simply because we have a couple of years extra life expectancy relative to men. We often live a couple years longer than our spouses. We might provide some level of care for our spouses, but there's no one left to care for us at the end of our lives. So if you're part of a couple and you're trying to decide how to address the long-term care risk for your household, it's super important to make sure that you are addressing that risk for your female partner, because the data suggests that she's likely to live a couple of years longer than her male partner. I like the idea of thinking about kind of a fourth bucket when thinking about how much to set aside for long-term care and sort of how to mentally segregate this portion of a portfolio. So I had earlier talked about kind of that 3-bucket setup where you've got buckets 1, 2, and 3 for your lifetime spending. Well, this bucket 4 is maybe an eventual long-term care spending bucket. And there's a nice level of optionality with that bucket as well. So if you end up not needing long-term care, and the data suggests that roughly 50% of us will have some type of long-term care need and 50% of us will not. So if you end up not needing long-term care, those funds can be held to be given to your heirs or given to charity. If you end up living to be 105, those funds can be used for that longevity protection. So I think that there's a nice level of optionality as part of this as well. And finally, I just wanted to mention for people who have a lot of wealth tied up in their homes, or if you have significant home equity due to home price appreciation, that can be kind of a last resort to think about with respect to long-term care, that even if you do not have sufficient funds in your investment portfolio to set aside for long-term care, that your home equity might be able to step in and provide that for you, either through a reverse mortgage or by selling that home outright to pay for long-term care. So that's, I think, something that can provide sort of an added sense of peace of mind if you do have home equity in a worst case scenario and you've exhausted your investment portfolio, but you would still like to use your funds to cover long-term care. Well, that home equity might be there to provide those supports. I want to touch briefly on the virtue of drafting an estate plan. I think sometimes people think that this is for people with very high levels of assets, but an estate plan is important regardless of your asset level. And the key components include beneficiary designations. That's kind of the front line of your estate plan. You might not necessarily think of them as part of your estate plan because you didn't draft them in your attorney's office, but they're nonetheless a portion of your estate plan. Definitely, you want to think about having the powers of attorney drawn up for healthcare and financial matters. Even if you don't sit down with an attorney, you should be able to find some forms that correspond with your state. And you can download those forms and get them signed and name those powers of attorney, the people who will serve as your agents if you're unable during your lifetime to make healthcare or financial decisions for yourself. The idea is that by drafting these powers of attorney, you're naming specific individuals to step in and make those decisions. You also want to think about having a will and having a living will or an advance directive that states your attitudes toward life extending care. Trusts may come into play in some cases. And you'd also want to think about having an executor for when you pass away, the person who you want to execute your estate plan in accordance with your wishes. Your executor may or may not be the person who you have named as your agent under powers of attorney. It's important if you haven't revisited an estate plan for a long time. So maybe you drafted an estate plan when your children were very little and now they're not so little anymore. It's really valuable to keep your estate plan up to date as your circumstances change. As new family members come online, as your situation changes, you want to make sure that that is addressed in your estate plan. And then finally, I would say that there are increasingly some fairly simple, low-cost ways to draft estate plans. They're certainly better than nothing, but I think it's often valuable to get a second set of legal eyes on your estate plan, even if you have used some sort of an online estate planning service. It might be valuable to chat with an attorney just to make sure that you're thinking through the key variables in your own situation, whether special needs loved ones, or maybe you have family members who have addiction issues, or whatever the case might be. There might be a reason to address those situations specifically with your estate plan. I would also say that you don't want to neglect the softer side of your estate plan. So you would want to articulate your attitudes toward end of life care with a little bit more nuance than perhaps you could with that advanced directive or living will. And here I would call out the Conversation Project as a really neat resource, a free resource that you can download to kind of have some of these conversations with your loved ones about your attitudes, your plans, and your wishes for your pets. Pets, as we all know, are just like family in many cases. You want to make sure that you have set aside plans for them, that you have articulated those plans as part of your estate plan. You might also want to articulate your vision for the distribution of your personal assets, whether special possessions, things that are worth a lot or maybe not worth a lot, but sentimentally worth a lot. You might want to set aside special provisions for them in your estate plan. And another thing I think that's worth thinking through is just your attitudes toward the disposition of your personal property. So is your thought, I want you to get top dollar for this stuff, or I want you to do whatever lightens your load? Kind of give your loved ones a sense of where you fall on that spectrum, and also call out for them if you do have articles in your household inventory that are worth a lot, where it might not be apparent that they're worth a lot. I think you want to call attention to them as well. And finally, plans and wishes for your funeral and memorial. I think that if you've had loved ones pass away and they've left you a sense of what they wanted in terms of their memorial, that can be worth its weight in gold as someone who survives them. To have a sense of what they wanted really provides a lot of peace of mind in terms of how to proceed. Finally, in terms of your estate plan, I love the idea of leaving your investment accounts in a state that is very easy to hand off to your loved ones. So I love the idea of creating what's called a master directory, where you are articulating all of your investment accounts, any professionals you deal with, whether attorneys or CPAs or investment advisors, and just give a simple overview of whatever strategy you're using to manage those assets on an ongoing basis. It shouldn't be overly complicated. It shouldn't be something that it takes pages and pages to describe. Ideally, you should be able to clearly articulate it, maybe even fit it on an index card. But if you are creating this master directory, kind of this inventory of your various investment accounts, you just want to be sure to keep it safe, because you've got sensitive information in this document. So you either want to encrypt the file if it's some sort of a digital file, or you would want to put it under lock and key if it's a physical document. You'd also want to share instructions about where to go for cash on an ongoing basis. So certainly this is a place to loop in your financial power of attorney to kind of read them into whatever strategy you're using for household cash flows. If they need to step in and manage for you, you want to make sure that they are not flying blind, that they are operating with some sense of how you are doing things. And importantly, that you're telling them which assets to not touch because you have other plans for them. So those highly appreciated investment assets that you hold in a taxable brokerage account, for example, that's a great example of something where you'd want to be very clear about the importance of having heirs inherit those assets from you rather than tapping them during your lifetime. So just bear in mind that other layer of estate planning. It's not all sitting in the attorney's office. Some of this is on you to make sure that there is a smooth transition of your financial affairs to someone else if that might need to be the case. And finally, just a shout out for simplification. Those of you who have read my work on Morningstar.com know that I'm a huge evangelist for minimalist portfolios. We often hear about people managing very complicated portfolios, and I just do not believe it has to be that way. And especially as we age, I think it makes a ton of sense to try to reduce the moving parts in our portfolios, to try to reduce the number of financial providers we have, the number of accounts within them, and then to simplify the investment types that we hold. So I've often talked to a lot of kind of investment enthusiasts, people who really enjoy the process of picking individual stocks, for example, or individual bonds. I do think that as we age, and particularly if we're doing some of this stuff on our own, we want to try to reduce the moving parts in our portfolio. We want to try to skinny down the number of holdings. And here, I think index mutual funds can make a ton of sense, where you are buying basically broad market indexes that give you a lot of market exposure in a single shot. There are a couple of other advantages of that type of investing. One is that it tends to be very, very low cost, and it can also be quite tax efficient. So if you have those non-retirement accounts, the tax drag from especially stock equity indexes is very, very low on an ongoing basis. And finally, if you have been a DIY type and you're getting into retirement, and certainly if you're getting into later into retirement, I do think it's worthwhile bringing on a financial professional just to have another receptacle for your investment assets, another set of eyes on your plan on an ongoing basis. I have focused on investments for, more than 30 years now, but I personally have a financial planner, and that's one of the key reasons that my husband and I have a financial planner is that we just want someone who is there to know what we have. If something should happen to my husband and or me, that someone would be able to say, well, here's where they hold their investments. And someone would be able to help with the ongoing management of our financial affairs if in case there were some kind of disruption. So that is the end of my very long remarks. I have a couple of links about how to find me. My book is called How to Retire. I'm a fixture on Morningstar.com. I love doing educational sessions like this one, and I wish you all the best on your retirement journey. Thank you so much for watching today. I'm Christine Benz.